How's it going, everyone? I am Dan Lohmar, certified financial planning professional with United Wealth Management, coming at you with another video. It's a subscriber question again this week, and the question is, which are better, pre-tax or Roth contributions? And it doesn't matter if it's a 401k or an IRA, the concept is the same. That's what we're talking about today. Before we get going, three really important things that I think are going to help you. And number one, navigating these questions of these different account types and contribution types can be very confusing. Down in a link in the show notes on YouTube there's a link down there where you can navigate, you can download some flowcharts that will help you figure this out for you. Those can be very helpful. Number two, thanks for submitting your questions. So as a service to all United pilots this year, I want to answer these one-off questions like this in a short video format. That's what I'm here for. If something's on your mind, it's probably on someone else's mind too. So submit your questions. And number three, before we get going, remember to subscribe and hit the bell icon so that you know when new videos come out. So let's get right into it. The essence of the question is, which is better, pre-tax contributions or Roth contributions? And you know what? The true answer is, it really depends. It depends on your situation, but let's talk about that right now. The essence of the question is, because we're talking about tax differences in these different contributions types. So the essence of the question is, are we in a higher tax bracket now or in a lower tax bracket in the future, way to expect it to be, or are we possibly in a lower tax bracket now and we expect our taxes to be higher in the future? That's the essence of the questions. Let's review the two account types real quick. So in pre-tax or traditional account types, like a traditional 401k or a traditional IRA, we put money in before taxes. So we get a tax break up front. That money goes in there, it grows tax-free, but then when we take it out, in the years we'd expect to have a lower tax rate, then it comes out, it gets taxed. But again, we're kind of getting that benefit because we're saving the taxes up front, and we would expect it to be at a lower tax rate in the future. So that's the essence of the contributions of a traditional 401k or traditional IRA. Now, on the other side of that, you've got the Roth contribution. Those contributions go in post-tax. So we get some money, we pay taxes on it, and what we have left over is what we're putting into a Roth 401k or a Roth IRA. That money goes in there, it grows tax-free, and then when we take it out, it comes out tax-free. So we would expect it to do that because we would expect our future tax rate, our retirement tax rate, to be higher for some reason. So that's the big difference between those two types of accounts and those two types of contributions. The differences in tax rates, whether we expect them to be lower today or lower in the future. So that's the essence of it. But the question is, how do we really know? Do we really know what future tax rates are going to be today versus what they are in the future? We don't know for sure, but we can take some education, an educated guess, and really try to apply it to your situation. But there are two big drivers of personal income tax rates. That's tax laws and then income level. So first of all, tax laws. A good example of that is the Tax Cuts and Jobs Act of 2017 that lowered our tax rates to what they are right now. Now, a good example of that changing is that they're supposed to sunset in 2025. So they're going to go back to the original tax rates. So at a minimum, there's a little bit of a tax rate in the future right there. And that's not to say that there could be new tax laws that completely get rid of the Tax Cuts and Jobs Act that raise taxes in the future, possibly lower in the future. I don't know. That's part of your financial planning situation where you can take an educated guess whether you think tax rates by law will be higher or lower in the future. But that's just a good example of tax laws and how they can affect tax rates. And number two is personal income levels. That's the second thing that affects your tax rates. So are you making more money now? And do you expect to make less when you're retiring? So let's look at a couple examples of that where it's pretty obvious. So if you're late in your working years and you're making your highest income, maybe a couple years before you retire, you would expect that you might be in one of the higher tax brackets during that time period. And in a couple years when you retire, you'd expect your taxes to be lower and at a lower tax rate because of your income levels. That'd be a situation when you might want to make pre-tax contributions to a 401k or a IRA. So the traditional side of that. And then there's times too where it's a little more obvious where for a Roth contribution, say you're in low income years, maybe you're younger, you're not making as much money, maybe you're in a year you get laid off. So those are situations where you're in a lower tax bracket because of your income level. You'd be better off, possibly would be better off to make those Roth contributions, pay the taxes up front, and then let it grow. And then when you take it out in retirement, when you'd expect to be in a higher income bracket, then you would take that money out tax-free. That's assuming they're all qualified withdrawals. We won't get into that, but that does assume all those things. So those are the biggest differences. Now, there's times when you're in the middle. Maybe you're in your 40s and your 50s, and you really don't know what your tax rate is going to be today versus what it is in the future. It's a little bit more of a guessing game between the laws and income levels and stuff like that. And that might just be a situation where you might want to do a little bit of both, maybe a little bit into a 401k, a traditional, maybe into a little bit into the Roth. So that's just something you can decide in your financial plan. So that's the big essence between pre-tax and Roth contributions and these different account types. Now let's step back for just 1 second and just completely disregard the tax differences in the tax side of this. If the question comes up and it says, hey, I just want to save as much as I can. I just want to put as much savings into my accounts, and so I have as much as I possibly can in the future. The way to go in that situation are with the Roth accounts. And the reason is because everything that goes in there is 100% yours. You don't owe any more taxes on it. So in 2021, if you're over 50, you can put $26,000 into a 401k. So that's the equivalent of about $34,000 on a pre-tax basis, okay? If you put $26,000 in there on a pre-tax basis, if your tax rates stay the same, you're only going to pull out about between $19,000 and $20,000 of that, because you're going to owe a portion of it to the government in the future. So again, if you just want to maximize your savings for the future, then the Roth accounts are the way to go as far as that goes. So look, I hope that helps. Again, I appreciate your questions. Keep them coming. If you haven't done it, go down to the link in the show notes on YouTube and download these flowcharts. They can really help you out. Keep your questions coming, and if you haven't done it, remember to subscribe and hit the bell icon so you know when new videos come out. Until next time, I'm Dan Lohmar, CFP professional with United Wealth Management. Until next time, fly safe.